Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 341 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including seasonality, geopolitical volatility, valuation comparisons, investor positioning, and creating an ethical will. Whether you are tuning in for market insights, planning tips, or just staying informed, there's something here for you. So good morning, Matt.
Good morning, Mark.
Outdoing me just a touch with a suit and tie today.
Yeah, people got to look me up on YouTube. This is a rare occurrence for Matt Jessup.
Yeah, well, briefly tell everyone why you're dressed to the nines.
Big day here in Dayton. It's the YWCA of Dayton's Women of Influence event. It's their key mark event. My wife, Rachel, is the head of the board of the organization. Their key mark fundraising, they're able to honor tremendous women with awards over their lifetime. It is going to be a fabulous event, and it's being held at the newly renovated Dayton Convention Center.
Awesome. Yeah, it's a great cause. I was there. We were just talking before we started recording. Was there a couple of years ago with you guys, and it was a great event. So
great event. I think they're expecting close to 800 people.
Wow. Awesome.
Yeah.
Awesome. Well, as always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from YCharts and as of the market close on March 11th.
Okay.
S&P 500 index is down 1.5% so far for the month and down 1% on the year. Dow Jones Industrial Average down 3.2% for the month and down 1.3% for the year. The NASDAQ Composite Index up 0.2% for the month and down 2.3% for the year. The Russell 2000 Small Cap Index down 3.3% for the month and up 2.7% for the year. And the Vanguard All World Ex United States Index Fund getting crushed this month, down 5.8% for the month, but still up 4.8% for the year. 3-month Treasury rate at 3.71%, the 2-year rate at 3.64%, and the 10-year rate at 4.21%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
So moving on to big headlines and current events from this past week, I think the biggest thing, obviously then the continuation of the Iran conflict that Aaron and I discussed on last week's show.
Yep.
February jobs report came out last Friday, and the markets didn't particularly love it, Matt. U.S. non-farm payrolls came in at 92,000 jobs lost when there was a consensus for adding 59,000 jobs, which is a pretty big difference.
Sure.
And the unemployment rate crept up marginally to 4.4% from 4.3%. And average hourly earnings growth came in at 3.8% year over year and 0.4% ahead of last month. So me interpreting that data, we had a ton of job losses with higher wage growth, which isn't a great sign necessarily for inflation. And before I get your take on this, Matt, there was a post from a guy I followed for a while. His name's Cullen Roche. He puts out a lot of good content. He posted on X back on March 6th last week and said, hard to see how falling labor markets and surging gas prices don't force a swift end to this war. This is all just a terrible thing for the economy. Am I wrong? ? So what are your thoughts here?
I think there's a lot of skews in this data right now that is really not giving us a clear picture on where the employment situation stands. I'll give you a good example. If you dig into the numbers, there were some strikes on the West Coast in the healthcare sector that I think accounted for north of 60 to 65,000 jobs that were reflected in these numbers. So do I think that the labor market is robust? No, I don't think it's robust. But I think on the flip side, I think we are sitting on an equilibrium of unemployed versus job openings. And this is a little bit of a Goldilocks scenario if you're an employer, right? Because I think you can find good talent right now. And I think once we start to see a little bit of this geopolitical uncertainty be removed, let's assume that's the case over the next quarter or two, you could see a tee up for the second half of the year. That's the optimist in me looking at that.
Right.
In addition, I think the data is going to continue to be skewed because of the current government shutdown.
Right.
So I just think that that is definitely an area that is going to be challenged to get a clear picture.
Yeah. Yeah. Okay. Last thing I had, and you actually brought this to my attention a couple of weeks ago when we were traveling for work.
Yes.
Just wanted to share a brief blog post that was on Business Insider that detailed what happened when a Meta director let an AI tool take over her email.
Oh, before you say this,
Okay.
I want all of our listeners and viewers to really think through the disruption fears that are being discussed. You have technology executives getting in front of TVs right now and saying to people that it's going to disrupt all this stuff in the next 12 months, all these white-collar jobs. Listen to what Mark's about to tell you.
Yeah, it's an interesting one. So there's a AI tool out there called OpenClaw, and it lets AI operate your computer the way a human would, essentially.
And this is getting the usage of this software and the disruption that people are claiming will happen in a very short period of time. Mm-hmm. Continue.
Right, because most AI tools, at least now, just generate text or they analyze data that you give it.
That you input,
right? But OpenClaw goes a step further, and it can actually perform tasks on your computer without you doing anything, right? So you can give it a prompt or a command to, schedule appointments and go through your email.
Clean up my email,
right.
And it will make assumptions on its own.
Right. So Meta's alignment director, Summer Yu, hooked up OpenClaw to her inbox, and then it just tried to delete all of her emails, like just went on a delete spree, right? So even the people hired to keep AI aligned can't always control it and keep it in line. And she claims that the bot went out of control. According to photos that she posted on X, it ended up planning to delete her emails, and it wouldn't stop after she directed it not to. OpenClaw bot said that it would trash everything in the inbox older than February 15th. And this lady tried to stop it multiple times. First, she messaged it and said, don't do that. And then the bot just kept planning to delete the inbox. She said, stop OpenClaw. I could not stop it from my phone, you wrote in her post. I had to run to my Mac Mini like I was defusing a bomb. So it's just an example that there's still a lot of security concerns and issues to work out with AI before it becomes, I guess, fully autonomous.
Let's call it mainstream.
Mainstream. One of the things in our industry that, and this was back when, this was a decade plus ago, because I remember this when I interned at Schwab down in Phoenix, Arizona.
Continue.
Their big thing was their robo investing platform. And everyone was like, this is going to take the job of financial advisors. Financial advisors are going to be useless.
Continue.
Yada, yada, yada. And you can say this about any industry with AI now, right? And I'm not saying it won't get there, but we're not there yet. I don't think we're even close.
And that's my main point is eventually will these things be more mainstream? Yes. Mm-hmm. But the time periods that people are speculating on, I think are very unrealistic.
Yeah.
Especially, it's one thing to think about it in theory, it's another to think about it in practice. Take the financial services industry. Do you think any custodian that actually holds client money is going to experiment with this stuff? Come on.
Yeah.
No.
Yeah. So it's, the overblown fears of AI taking everyone's job. I don't think it's any different than technologies in the past, whether it's the internet or, cars replacing horse and buggies or, automated machines replacing line workers for manufacturing jobs. It always seems super scary whenever that next technological evolution is in front of you. But everyone seems to hype this one up a lot more because they're like, well, it's gonna do everybody's job, and I just don't think that that's ever going to be the case.
Will it make productivity a lot better? Yes.
Yeah.
So Jeremy Grantham, a GMO, sorry, buddy, you're probably going to see more productivity gains over the next decade.
Right.
But when I think it comes to the speed at which this occurs, I feel that the market in general, my opinion, is misguided on this topic.
Yeah, I would agree. Moving on to tweets, articles, research from this week. First thing I had was a post on X from Ryan Dietrich on March 6th. So Jenna will throw this up in the YouTube video. It'll also be in our show notes. So it's a chart of the 4-year presidential cycle, which we've talked about ad nauseum at this point on this show. And it shows Trump's second term here. And it's tracked pretty well with the seasonality of how a midterm year typically plays out. The first, year and a half of how the presidential cycle plays out. So usually a president's first year in office tends to be pretty good, up, high single digits for the year, right? Then the midterm year comes, and that year tends to be a little weaker. Still tends to be positive, but during the middle of the year, you get some significant weakness, right?
Tends to be right before the midterm election.
And then the pre-election year,
year three.
Year 3 is the strongest year out of the entire 4-year cycle. And then the election year 4, is also pretty good, but not as strong as year 3. So the reason I bring this up is, the title on this chart is Midterm Years Can Be a Pause. And when I looked at this chart, I thought to myself, yes, there's some unsettling geopolitical things going on in the world right now, but the market action up until this point really hasn't been that abnormal for a midterm year.
Great point, Mark. If you were to take the headlines away and look at the price action,
you're like, oh, this is what, Mark and Matt have been talking about. Like the market's just a little weak during this time of the year.
Great point, my friend.
And another piece to that, I'm actually going to skip down to my last piece, is this was a post on X from Equity Clock on January 26th. So looking back towards the beginning of the year, they put a graphic out there of just the seasonality of the average year for the S&P 500 over the past 20 years. And it shouldn't come as any surprise that what's usually the weakest point of the year, it's like middle of February to middle of March, right?
Guess what we're in right now, baby?
Middle of February to middle of March. And it just kind of lines up with, the midterm weakness as well. So I just don't think we should be surprised by what we're seeing so far, at least from a market standpoint. Last thing I'll point out before turning it over to you, towards the end of the year, we talk about some specific metrics we look for at the beginning of a new year to give us an idea of how stocks are going to do in the new calendar year. So this was a post on X from Isabel Net on February 2nd with data from Carson Investment Research. Jenna will put this up on the YouTube video. She says, history favors the bulls when the S&P 500 rises more than 1% in the first 5 days of January, which it did, and January as a whole closes in the green, which it did this year. The market has finished the year higher 92% of the time with a median 19.1% gain since 1950. So there's only been, since 1950, one negative full year return, and that was in 2018 when the first 5 days of January were positive and the full month of January was positive. Now, that's not to say that we couldn't have a big correction between now and the end of the year. I think the average midterm year corrects about 17% from the market peak to the market low.
Correct, sir.
But we can still finish in the green for the year. So both of those things can be true. So I think it's just important to know that, hey, midterm years, typically some volatility and some weakness at some point in the year. Usually it's Q2 or Q3, the majority of it.
Yes, sir.
But then as we get into Q4, things start to look a lot better, and it wouldn't surprise us if we finished in the green for the year for stocks.
I think that's very well said. I'll take it one step further. On the stat you're mentioning about the average year two of the presidential election cycle, that data set goes back to 1950. And if you look at it, it is 17.5% to the downside is the average intra-year correction. The average intra-year rally since 1950 in year two of the presidential election cycle, 31%.
Wow.
31%.
So that just goes to show it. Yeah. And listen, that's what I've been telling some of our clients. It's like, listen, I would expect some volatility over the next couple of months, but guess what? When we get to late summer, early fall, there might be some really nice buying opportunities.
Absolutely. And, I think what's happened, especially over the past decade, Mark, is media has pushed this to where people perceive their time horizons being like, oh, I wonder what the market's going to do this week or this month, where a majority of our clients, what happens this week and next month doesn't matter.
Right.
And we are making investment decisions on where investments that we're selecting for client accounts, where they're going to be 12 months plus.
Right. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
All right, here's my first piece. This is a kind reminder about geopolitical volatility. This is going to be a chart that Jenna will put up that is illustrating the price of oil this past weekend. Okay. So for our viewers and listeners, Mark, that aren't as plugged in as you and I to the markets, with the geopolitical, I'm going to call it noise or headlines, we've seen some pretty extreme volatility, and one of those poster childs right now is oil. So I'll set the headlines aside, and I'm just going to talk about the price action. So on Sunday, the price of oil was sitting around $100 a barrel on Sunday. And going to bed on Sunday evening, and it's rallying. It's about 110. It peaked in the middle of the night at $120 a barrel. And then the subsequent day on Monday, it was back below 90. These moves are large and extremely rare. And it's a kind reminder to listeners and viewers, you do not want to sit here and try to time this market on a short-term basis. Mm-hmm. It is very challenging. That's my word of wisdom. Now, am I going to see maybe a couple more times of this type of price action in a 24-hour period and things like oil in my career? Yeah, probably a couple more. Very rare.
Yeah.
All right, my next thing I'll throw out there is going to be a discussion on comparisons of valuations, okay? So listeners and viewers, what tends to happen when the market becomes uncertain and you have a sell-off, people tend to buy the safe havens. And the traditional safe havens are things like utilities, consumer staples, healthcare. They would tend to be, let's call it the poster children for the safe haven trade. Well, there was a post by David Marlin, and the date on this, Mark, was February 23rd. And he had a post, and it says, and I'll quote, "The forward PE is price to earnings, how much of a valuation you're paying for a company. The forward PE on the tech sector is now at par or equal to consumer staples. In other words, the market is now valuing tech as the same multiple as boring, slow growth staple companies. This has only happened 3 times in the past 7 years. The initial hit of COVID at the beginning of 2020, the 2022 bear market, and Liberation Day last early spring." Jenna will put up this chart for our YouTube viewers. This will be in our show notes. And what you're going to see is in the orange, anytime those consumer staples rally, they get more expensive on a valuation basis. When people sell off the more growthier areas of the market, in this example, technology, they get cheaper on a valuation basis. My word of wisdom here is these things don't tend to be at a point of dislocation for an extended period of time. And here's the challenge with it. When it feels uncomfortable to buy names, in retrospect, that's typically the good time to buy them.
Yeah.
Your thoughts and comments on this?
Yeah, I was, Jenna might have caught that I was kind of smirking or smiling when you were saying that, because Aaron or I think, had a similar topic last week, but it was specifically talking about, I think, the Mag 7 minus Tesla compared to consumer staples. But this is talking about the entire tech industry, which is
the entire sector of tech,
which is very interesting. Yeah, we talked about it a little bit last week. You know, this doesn't make sense long term with the amount of growth dispersion between the two sectors. So eventually, I would imagine this is going to resolve itself. And you know, at some point in the future, we're going to be looking back on this moment and saying, wow, that was a really good opportunity to add to tech.
Let's just say I have my 10-year-old here, okay? Let's just say Micah was sitting right here next to me, and I said, Micah, we're going to consider buying 2 different sectors of the market. This first sector is nice and safe, and it pays you about a 3% dividend yield, and it grows its earnings by about 5% a year. This other one over here, let's just say it doesn't pay you any dividend, but it's growing its earnings mid-double digit. If I had that conversation with him, he'd look at me and say, why is anyone with a long-term time horizon buying consumer staples, Dad?
Right. Yeah. No, it's a great point. Great analogy.
Oh, boy.
Love it.
All right, here we go. This is my last piece. And this is where I think I'm going to have a hot take for some of our listeners and viewers. Okay? So I've been in the industry several decades, and I see these points of positioning or pessimism in the market. So there was a post by Steve Burns. Mark, the timestamp on this, sir, is March 4th. So Steve posted a picture, and it says, investors now hold the most put option protection in this data set going back to 2010. And it shows the current S&P 500 customer delta positioning. This is where I have to go explain this first to our listeners and viewers. So first of all, put options are financial contracts that give the buyer the right, but not the obligation, to sell an underlying asset, such as a stock or an index like the S&P 500, at a predetermined price before a specific expiration date. These are commonly used by investors to hedge against potential declines in asset prices or to speculate on downward movements, profiting if the asset's value falls below that predetermined strike price. The extreme level of put option ownership right now, shown on this chart, Jenna will put it up for our YouTube viewers, it reflects unprecedented bearish sentiment and heavy hedging amongst investors. Here's the key. In my experience, this type of data often signals excessive fear in the market. Historically, such extremes have acted as contrarian indicators, frequently preceding market reversals or rallies as the overcrowding in these protective positions unwind. Could this bearish price action continue to last longer than people think? Of course. But if you're a long-term investor, this type of data is welcomed in my opinion. It's my version of seeing, quote, light at the end of the tunnel. Those are my prepared remarks. My off-the-cuff remarks will be a little bit more of a hot take. Really, at the end of the day, there's not a lot of people out there, I think, that are thinking the market could rally in light of some of the geopolitical noise. And I'm just going to throw it out there. This is my personal opinion, with how the market's relatively holding up in light of the news feed and how the positioning is so bearish right now. In my experience, you will tend to have some sort of a pretty strong short covering or relief rally. Could that take another 2, 4, 6 weeks? It could. But I think if you're a longer term investor, and we're going to have earnings coming out again in the middle of April, which is not that far away, I would be careful if I were trying to speculate on further downside. Yes, you might hit a home run. You might get the timing right. This is definitely a market environment where you want to have a longer term time horizon, own quality stocks that you've done research on. That's my 2 cents. Mark, your thoughts.
Yeah, I think you made a great point, and I couldn't have said it better myself. We talked about the intra-year average drawdown for stocks. So let's just say you sell, in the middle of that drawdown, right? So you're protecting a little bit to the downside in the short term, but then, like you said, the median or average intra-year rally is 33%.
31.5.
So what are your chances that you're going to catch the absolute bottom to recover more?
Statistically low.
Right? So it's just the last thing that I wanted to mention there. So just think about that.
I think it's important.
Yeah. Last thing I have, quickly, just the financial planning topic of the week. This was a blog post from Mara McInerney Rowley titled 3 Types of Wills You Should Know About Before You Die. So Mara is a death doula who helps advise on end-of-life planning. And she talks about the different types of wills. And I'm not going to spend much time on the first 2, the financial or durable, financial will or last will, or the living will or your advanced healthcare directive. We talked about those several times before on the show.
Yep.
So people can go back in past episodes and check that out. The one that I want to talk about just briefly, Matt, is something she calls an ethical will. And I haven't really gotten into this until I read this article.
I'm all ears.
She says that the document is not about money, but it might be the most valuable will of all because it's the part of you that lives on, something that your friends and family can return to after you're gone. The contents of an ethical will are only limited by your imagination and can come in many forms: a letter, a book, a video, a song. The aim is to reflect on your life experiences and pass on values, lessons learned the hard way, stories, favorite memories, beliefs, wisdom, and hopes, or a message to loved ones. Here's an example of some prompts within an ethical will. My biggest regret is ... The recipe for a life well lived includes: after I die, I hope you remember X. Here's what I wish someone had told me sooner. And this is my philosophy on love or money or whatever topic you want to discuss. So I just thought that this was kind of out there and a little different than things we typically talk about.
I like this.
I was at a conference recently, and there was a guy giving a presentation, and I thought it was kind of funny, because it talks about sending a message to your loved ones. He said, and he's a tech guy, he said that he scheduled a tweet for the year 2080 or 2090 to come from his account when he's obviously no longer on this earth, to freak his kids out, which I thought was kind of funny, or to say something to his kids, coming from heaven. So I thought that this was good, because at least in my experiences, when I've had loved ones pass away, sometimes unexpectedly, you go through your head of, I never got to tell this person X, Y, Z. So yes. I think this would be a good way to, get some of those things out there that you might not have had the chance to do. So
I love that you picked this.
Yeah. So I thought it was an interesting one. Again, never really considered this before I read this article. So Jenna will have the link to the full article from Mara in our show notes if you want to go check that out.
And all of our show notes are on our social media sites.
They are.
All the popular ones you can think of.
Anything else before we leave it there for the week?
No, I think I vented about kind of where the market's at and all the doomsayers. I think I've been very clear on that.
Okay. Well, thanks everyone for listening to episode 341 of the Independent Advisors Podcast. Catch us next week for episode 342.
We'll see you next week, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.